Singapore equities are expected to gain ground this year against a global backdrop of cooling interest rates, and analysts are betting big on sectors related to tourism and real estate. Real estate investment trusts, or REITs in particular, have been making a comeback. Well, despite a sluggish start last year, Singapore REITs scored dividend returns of more than 9% in December, logging its best ever month on record. And this 11th hour jump in profits catapulted its full year returns from negative 9% in October to end the year in the green. It's certainly welcome news for Singapore investors, whose love for property attracted dozens of REIT listings over the past 2 decades, making the country the biggest Asian market for property trust listings outside Japan. Well, CNA's Olivia Marzuki explains to us how real estate investment trusts work as an investment tool.
Real estate investment trusts, or REITs for short, is one way you can be a property investor without all the hassle. You basically put your money in an investment company that owns and operates income-producing real estate. This ranges from office buildings, apartments, shopping malls, hotels, to hospitals, and even nursing homes. REITs are publicly traded, so you can buy and sell them just like you would any other investment assets. By rights, REITs must give out at least 90% of their taxable income to shareholders in the form of dividends. And the dividend return from REITs is typically higher than that of other dividend payers. That is why REITs are seen as very lucrative income-generating asset class. They're also great alternatives to diversify your investment basket. REITs are not perfectly correlated with other asset classes such as stocks or bonds, and this means they can help to reduce the overall risk of a portfolio. And because they're publicly traded on stock exchanges, REITs are relatively liquid investment. Unlike traditional real estate investing, you can cash them out fairly quickly. Future yield potential for REITs is immense, and this is because the underlying real estate assets typically appreciate in value over time. It is worth noting here, though, that REITs are not completely risk-free. Just like any other investment, they are not immune to market volatility. Market sentiment plays a role in REITs, which means that their prices can fluctuate alongside other securities products, and they're also sensitive to changes in the real estate market. So if interest rates increase and demand goes down, it could lower property values and negatively impact your investment. And REITs' performance largely depends on macroeconomic conditions. A downturn in the overall economy can lead to a decrease in appetite for commercial real estate. So, investing in REITs may be a great way to earn passive income by buying into the property market indirectly. But remember, it has the same pitfalls as the property sector in general. In a high-rate environment, dividend payouts tend to underperform the wider market. For CNA Explains, I'm Olivia Marzuki.